if you track the markets at all. You are probably already intimately familiar with the visual chaos of a stock chart.
Oh, yeah. That endless jagged mountain range of green and red blocks.
Right, exactly. You log into your brokerage account, pull up a ticker, and there it is. Just shifting in real time with little lines poking out everywhere.
And for a lot of people, even those who follow financial news daily, looking at that chart feels, well, it feels like trying to read a foreign language where you only know about half the alphabet.
Totally. I mean, green is generally good and red is generally bad, but the actual day-to-day narrative completely escapes you. It just looks like a random series of price fluctuations.
Which is such a tragic missed opportunity, honestly,
Mm.
because the stock chart isn't a math problem to be solved.
No.
No, it's more like a financial seismograph. Those specific shapes, those spikes and drops, they're measuring the exact moment thousands or even millions of people panic, hesitate, or get greedy.
We tend to look at charts and assume they're just abstract representations of corporate value, right?
Right, but they aren't. They are a daily autopsy of market psychology. Every single mark on that screen is a footprint left behind by human behavior.
And deciphering those footprints is our mission for this deep dive. Today, we're unpacking a really comprehensive guide from the Market Beasts script, and it focuses entirely on reading candlesticks.
Yeah, and we aren't going to patronize you by explaining what a vertical rectangle is
Yeah.
or, telling you that you should buy low and sell high.
Right, you already know the basics. Our goal today is to look at the underlying mechanics.
We want to take those green and red blocks and reveal the multi-million-dollar battles happening inside them.
So the next time you open a chart, you aren't just seeing price markers. You're reading a real-time story about institutional confidence, retail fear, and market exhaustion.
Exactly.
Okay, let's unpack this. The core argument in our source material is that before you can read the broader trend, you really have to understand the individual words of the market.
Which are the individual candlesticks?
Right. And time is the canvas here, isn't it? Because depending on your settings, a single candle can represent 1 minute of trading or an entire month.
Yeah, but if we focus on a daily chart, which is, the most common time horizon for standard analysis,
Like the classic daily view.
every single candle represents an entire day of trading compressed into one visual unit.
Wow.
Yeah, it encapsulates every algorithmic trade, every panicked retail sell-off, and every institutional buy order from the opening bell to the closing bell.
That's a lot of data.
It is. And the guide refers to the 4 critical data points inside that candle as OHLC.
Okay, open, high, low, and close.
Exactly.
Let's break down the mechanics of that for a second. The open is simply the price at 9:30 a.m. when the market wakes up.
Right.
And the close is where it settles at 4:00 p.m. So the space between those two numbers forms the thick part of the candle, which we call the body.
Right, the body. And if the close is higher than the open, it's green. If it's lower, it's red.
Simple enough. But the sauce points out that the color alone is just a superficial indicator, right? It's the size of that body that actually matters.
Oh, absolutely.
Yeah.
Because the body measures the net ground taken in the battle between buyers and sellers. It's a direct measurement of conviction.
So, meaning if you see a massive green body spanning a huge price range,
It tells you that from the moment the market opened, buyers stepped in with overwhelming demand. They bought up all the available shares. Sellers had to continuously raise their asking prices. And, this buying pressure never let up until the final bell rang.
it's basically total dominance.
Exactly. Total dominance. Conversely, a tiny body like where the open and close are only pennies apart indicates a complete lack of conviction.
Meaning the market couldn't make up its mind.
Right. Regardless of whatever volatility happened during the day, they just could not agree on a fair valuation.
Which brings us to the extremes of the session. Because the body shows us the net result of the day, but if the body shows us where the price opened and closed, what are those weird little sticks poking out of the top and bottom of the candle?
Yeah.
Like, do they matter or is it just market noise?
Oh, they definitely matter. Those are called the wicks or shadows.
Wicks.
Right. The upper wick marks the absolute highest price someone was willing to pay that day, and the lower wick marks the absolute lowest. But a wick isn't just a high water mark.
No.
No, the guide emphasizes that wicks are actually visual evidence of market rejection. What's fascinating here is the mechanism when you think about the underlying order book.
Okay, walk me through that. Let's take a long upper wick as an example.
Sure. So the price opens, and buyers aggressively push the stock higher. The candle is looking incredibly green and bullish, right?
Right, everyone's feeling good.
But eventually, the price reaches a level where a massive amount of institutional limit sell orders are just sitting there waiting.
Oh, I see.
Or perhaps the valuation gets so stretched that buyers suddenly suffer vertigo and stop bidding. Whatever the catalyst is, immense selling pressure steps in at that high price and violently pushes the stock back down before the market closes.
So that upper wick is basically the visual trail of a failed offensive.
Exactly.
It's like touching a hot stove. The market's price reached out, got burned, and immediately pulled its hand back.
That is a perfect analogy. The market tested that high level, got completely burned by an overwhelming supply of sellers waiting in ambush, and recoiled. The wick is the scar left behind from that burn.
That makes so much sense.
And the exact same recoil mechanism applies to a long, lower wick.
So the price drops significantly, panic might be setting in.
But then it hits a hidden floor. Buyers decide the stock is now fundamentally undervalued, or technical traders see it hit a historical support zone, and they unleash a wave of buy orders.
They absorb all the selling pressure.
Right, they absorb it all and push the price back up.
Yeah.
So a long, lower wick tells you that the market thoroughly tested a lower price and explicitly rejected it.
Okay, so if I'm interpreting this dynamic correctly, let's say I'm looking at a chart and I see a giant green candle.
Okay.
The body is huge, meaning the buyers dominated the net movement. The logical instinct for almost anyone looking at that is to assume the stock is strong, the momentum is undeniable, and it's time to buy. I mean, green means go.
Oh, yeah, that's the reflex.
But the guide explicitly warns against this reflex. Why is a massive green candle potentially a trap?
Because the trap lies in ignoring context.
Mm.
A candlestick is meaningless in a vacuum. It only gains significance based on its location relative to the broader trend.
Okay.
The source uses this really brilliant linguistic analogy here. Think of a candlestick as a single word, like the word fire.
Fire, right? If you just hear the word fire, you completely like the instruction.
Right.
Like if the larger sentence is, hey, let's sit by the warm fire, you pull up a chair. But if the sentence is, the building is on fire, you run for the emergency exit.
The context dictates the action.
Right.
So applied to the market, let's look at that massive green candle in two different contexts. In scenario A, the stock has been in a brutal multi-week downtrend. Blood is in the streets.
Right. Everything is terrible.
Suddenly you get a giant green candle. In that specific context, this shape represents exhaustion.
Oh, meaning the relentless selling pressure is finally dried up.
Exactly. And buyers are stepping in to scoop up a battered asset at a massive discount. That is a structurally bullish signal. It's a trend reversal.
But then in scenario B, let's say the stock has been rocketing upward for like 14 straight days. It's all over the news. Retail traders are getting massive FOMO.
And then at the very top of that mountain, you get a massive green candle.
Right.
In scenario B, that same green candle is incredibly dangerous. The underlying mechanism there is often a climax of euphoria.
Wow. Okay.
It's the late arriving retail money aggressively buying in at the absolute top, providing the perfect liquidity for the smart money, the institutions who bought weeks ago, to offload their shares and take profits.
So that giant green candle could be the grand finale of the uptrend, not a continuation.
Yes. If you buy there, you are basically buying someone else's exit liquidity.
Ouch. That drastically changes how you evaluate price movement.
It really does.
So what does this all mean? If a single word isn't enough on its own, are there a few specific words or candle shapes we should memorize to start building our vocabulary?
Yeah, absolutely. The guide outlines 4 foundational candle types. Not, obscure patterns with ridiculous names, but core representations of market psychology.
Okay, let's hear them.
Well, we've essentially covered the first 2. The strong bullish and strong bearish candles.
Those are those massive green or red bodies with virtually no wicks at all. Right?
Exactly. The lack of wicks on those strong candles is the key detail. If there are no wicks, it means there was 0 recoil. The opposing side didn't even put up a fight.
So a strong bearish candle, just a massive red block from top to bottom, means from the opening bell to the closing bell, buyers never once managed to push back.
Right. It is total capitulation and panic.
So if a strong directional candle is pure dominance, what does the chart look like when that unstoppable force suddenly hits an immovable object? When the buyers and sellers are perfectly matched?
That creates our third foundational shape, known as the doji.
Doji.
Yeah, a doji happens when institutional algorithms and retail traders clash so perfectly that millions of dollars change hands, yet the price doesn't budge a single cent.
Wow.
The open and the close are essentially identical, creating a shape that looks like a plus sign or a cross. You have an upper wick where buyers pushed and a lower wick where sellers pushed, but it all resulted in a multi-million-dollar stalemate.
It's visual indecision, like the market is just holding its breath.
Yes, and location is crucial for a doji. If you see a doji in the middle of a choppy sideways market, it doesn't tell you much. But if you see a doji after a massive prolonged uptrend, it means the buying momentum has suddenly slammed into a brick wall. The buyers can no longer overwhelm the sellers.
It's a primary signal that the trend is pausing and might reverse.
Exactly. Which leads directly into the fourth and arguably most psychologically intense candle type, the hammer.
The hammer. Visually, it looks exactly like a mallet, right? A small body sitting at the very top of the daily range, with an incredibly long lower wick hanging beneath it.
Yes, and the psychological whiplash of a hammer is severe. Imagine the session. The market opens and sellers immediately launch a massive offensive.
Okay.
They drive the price down, down, down. Panic is triggering stop-loss orders. The chart looks disastrously red.
I can feel the stress already.
Right. But then, deep in that valley, the sellers overextend. They walk right into a trap. Massive institutional buy orders trigger at that low price.
And the buyers counterattack.
Yes. They not only absorb the selling, but they counterattack, driving the price all the way back up to close right near where it opened. The sellers get totally routed.
Here's where it gets really interesting, though. If I see a hammer, meaning buyers just violently defended a level, isn't that my golden ticket to immediately hit the buy button?
Oh man, no. The expert firmly warns against this. A hammer is a signal to pay attention, not a guaranteed buy signal.
Wait, really? But didn't the buyers already prove their strength? Why do we need the next day's candle to confirm it?
Because you don't know yet if that counterattack was a genuine trend reversal or just a temporary dead cat bounce.
Oh, I see.
A hammer is an anomaly, and anomalies require verification. Suppose those buyers who stepped in were just short sellers buying back shares to cover their positions and take profit.
So that isn't new, sustained demand.
Right. It's just administrative house cleaning.
Yeah.
If you blindly buy a hammer and the very next day the sellers regroup and print a massive red candle, your capital is trapped.
You always need the next chapter, like the following candle closing higher, to confirm that the buyers are actually holding the ground they took.
Precisely. You must wait for confirmation.
That segues perfectly into the final section of our deep dive, where the source material puts all these disparate pieces together into a practical framework.
Yeah, the 5-step checklist.
Right. And they start by dismantling the most common mistakes beginners make when trying to read these charts. We've already addressed the green means go trap.
Which is huge.
But the next major pitfall is getting bogged down in the taxonomy. People spend weeks memorizing 50 different obscure pattern names.
Oh yeah, like the abandoned baby or the 3 black crows.
Exactly. And they entirely miss the point of the exercise.
The market doesn't care if you know the historical Japanese name for a pattern. If you understand the mechanics of buying and selling pressure, if you know that a long body means conviction, a small body means hesitation, and a long wick means violent rejection, you don't need a dictionary.
You can just look at any bizarre combination of candles and organically deduce who is winning the war.
Right. It frees you from rote memorization and forces you to focus on the actual flow of capital.
But to track that capital accurately, we have to talk about the most egregious mistake a beginner can make.
Ignoring volume.
Yes. Analyzing the shape of a candle while completely ignoring trading volume. The guide is incredibly firm on this. Volume is the total number of shares that changed hands during that candle's formation.
Yeah.
Why is the shape of the candle practically meaningless without knowing the volume behind it?
Because volume is the lie detector of the stock market. You can have a candlestick that looks incredibly convincing, but volume tells you whether the heavy hitters are actually involved.
Right, the institutions.
Think about the mechanics. A stock price can move up on very low volume simply because there happens to be a temporary lack of sellers at that exact second. It takes very little capital to move the price in a vacuum.
Let's paint a picture of how that traps people. Imagine you're watching a popular tech stock. It's been hovering right below a major historical resistance line at, let's say, $200.
Okay.
It's tried to break above it for weeks and failed. Suddenly, you see a strong green candle push right through $205.
The shape looks incredibly bullish. Total dominance.
Right. So you hit buy, assuming the breakout has finally happened. But you didn't check the volume.
That is where the trap snaps shut. Because if you check the volume bar at the bottom of the screen, you might see that the volume was a fraction of the daily average.
So that move wasn't driven by conviction.
Nope. It was driven by a few retail traders swapping a couple of thousand shares in a low liquidity environment. The big institutions, the pension funds, the algorithmic block traders, they were all sitting on the sidelines. They didn't validate the move.
And then the next day, those institutions return to the market. They decide $205 is fundamentally overvalued, and they dump 2 million shares.
And the stock plummets back to $180.
And you are left holding the bag because you trusted a shape without verifying the weight behind it.
Exactly the opposite happens on high volume, though. If that stock breaks through $200 and the volume is 3 times the normal average, that tells you institutional money has made a deliberate, structural decision to reprice the asset higher.
High volume validates the story the candle is trying to tell.
Precisely.
This all culminates in a 5-step checklist the guide provides to prevent these exact scenarios. It's a sequence of logical filters. Step 1. Identify the broader trend using a moving average.
You want to make sure you aren't trying to swim upstream against a macro current.
Step 2. Evaluate the location. Is the current price sitting near a historical support zone, or is it dangling in the middle of nowhere?
Step 3 is analyzing the body. Is the market showing conviction, or is it printing dojis and showing deep indecision?
Step 4 is reading the wicks. Where are the rejection zones? Have buyers recently touched a lower level and recoiled violently?
And finally, step 5. Is there volume confirmation to prove that the major players are actually backing up this price movement?
If you run through those 5 steps, you filter out a massive percentage of the false signals that constantly drain retail trading accounts.
The guide summarizes it beautifully. Candles show you the behavior, indicators like volume show you the confirmation.
And risk management, knowing exactly where you will cut your losses if the market suddenly changes its mind, is what actually protects your capital.
It's a complete paradigm shift. You stop looking for magic shapes that guarantee a profit, and you start looking for an alignment of probabilities.
Right.
You are using the chart to read the psychology of your opponents, finding areas where their conviction is weak, and your probability of success is mathematically higher.
We've covered a tremendous amount of structural mechanics today. The OHLC gives you the 4 basic prices. The body reveals who ultimately captured the territory, while the wicks expose the brutal, unseen rejections happening at the extremes.
And above all else, you must never read a candle in isolation. Context and volume are the ultimate arbiters of truth in a market full of deceptive signals.
By internalizing these concepts, you transition from being a passive observer of random fluctuations to an active reader of market sentiment.
Right. Mastering this isn't about memorizing magic formulas to get rich quick. It's about giving yourself a practical tool to visualize human behavior in the market so you aren't flying blind.
We've established that these charts are basically visual footprints of raw human emotion, fear, greed, hesitation, and irrational exuberance.
Definitely.
But as you open up your brokerage app tomorrow, as you look at your very next stock chart, I want you to mull this over.
Okay.
When a massive, unexpected global shock hits, say, a surprise interest rate hike or a geopolitical crisis overnight, and all traditional valuation metrics will go completely out the window, what do you think pure, unfiltered panic actually looks like when it is compressed into a single daily candle?
Oh, wow.
How deep does that lower wick have to plunge before logic returns to the market? Because once you start looking for the terrified human hands moving the capital behind the shape, you are never going to look at a stock chart the same way again.